Hey everyone, welcome to Talk Tickers. We're breaking down UMB Financial's second quarter earnings call from July 30th, and let me tell you, this was a quarter that really made waves. The numbers here tell a pretty fascinating story, so let's just dive right in.
Okay, so let's kick things off with the big one, the number that really got everyone talking. A massive 26% beat on operating earnings per share compared to what the analysts were predicting. And just so we're clear, this wasn't some tiny little beat. No. This was a statement quarter from UMB, a real blowout.
And the market reacted exactly how you'd expect. Shares gapped up right at the open. It makes total sense when you dig into the numbers here. I mean, look at this. It was just a clean sweep across the board. They beat on earnings, they beat on revenue, they even expanded their net interest margin by 14 basis points. And get this, their efficiency ratio improved by a full 10 points from last year. That's a really powerful combo of growth and, just running the business better.
So the big question is, right, what was actually driving this thing? How did they pull off such an impressive quarter? Well, when you look under the hood, it really comes down to two main engines that were firing on all cylinders. Okay, so engine number one is the real core stuff, right? This is the sustainable power coming from that big Heartland acquisition. This was the first full quarter, it was baked into the numbers, and bam, you see double-digit growth in both loans and deposits. That's your new foundation. But then you have engine number two, which was more like a nitro boost, a big one-time gain from the IPO of a company in their investment portfolio, Voyager Technologies. So you've got this steady, powerful core engine, and then this huge but non-recurring pop on top. And this really lines up with what management is saying. The CEO, Mariner Kier, he basically framed the whole quarter around these core strengths, all getting a major boost from that Heartland deal. And I think that's the key takeaway here, right? This wasn't just some lucky one-off quarter. This was the result of a big strategic move starting to really pay dividends.
All right, now this is where the story gets really interesting. Because after a quarter like that, a total blowout, what would you expect? You'd expect management to be super bullish, raising guidance, right? Well, they did the exact opposite. They came out and signaled caution.
And that, of course, was the million-dollar question on the earnings call. It's what every analyst and investor was thinking. Wait a minute, you just crushed it, so why on earth are you tapping the brakes on expectations now? What's going on here?
So here's what they laid out. Management's basically saying, hey, we need a minute to digest this big meal. It's all about execution now. They're guiding for their core margin to be essentially flat, because while some things are helping, other things like higher deposit costs are pushing back. They even told us to expect operating expenses to tick up a little bit. And really, the big takeaway from their guidance is this. All eyes, and I mean all of their internal focus, is on one thing, that massive system conversion for Heartland, which is slated for mid-October.
Okay, so we've got the huge beat on one hand and this cautious, flat guidance on the other. So what does it all mean for the stock going forward? Let's tie this all together and get to our thesis and our final rating.
So here's our call. First, looking ahead to the Q3 results, we're thinking they'll probably meet their numbers, maybe slightly beat on the high end of their expense guidance. But honestly, the headline number won't be the real story. Everyone's going to be listening for commentary on that October conversion. Second, what about the stock price? Well, it's already had a great run, up over 15% since the quarter ended, so we think it probably trades kind of sideways to up from here as the market just digests those gains and waits for proof that they're getting those cost savings. And that all leads us to step 3. Our official rating is outperform.
And here's why. Our whole thesis is that management's super conservative guidance is actually creating a pretty interesting opportunity. Yeah, the market has already rewarded them for the great Q2, for sure, but we don't think the full prize is priced in yet. And what's the prize? It's the $124 million in cost savings they expect to get from the Heartland deal. That October systems conversion, that is literally the key that unlocks all that value. If they can pull that off without a hitch, we think there's a really clear path for the stock to get re-rated and move higher.
So we'll be watching that October conversion very, very closely. And really, that's what it all comes down to. This isn't just some back-office IT project. It's the main catalyst. It could unlock over $100 million in savings and prove that the Heartland deal was a total home run. A smooth execution could send the stock way higher, but any slip-ups would really justify management's caution. So the big question for investors is, can they stick the landing?
This is not financial advice.